Thank you for checking out Philman Roll-Up and Associates Municipal Market Update for the week of January 19th, 2021. Philman Roll-Up and Associates is a municipal advisor to government. This week, we are fortunate to have Ms. Betsy Keene as a co-host to our MMU. Betsy is a managing director and head of municipal capital markets at Stifel Nicholas and Company. Welcome, Betsy.
Great. Thanks, Adam. Good morning. I'm happy to be here.
On our first slide, we show the historical MMD. The tan bars represent the range of interest rates that have taken place for each one of those maturities, dating back to 2005. And that red line represents where the MMD stands for each one of those maturities as recently as last week. One of the slides that I typically show is inflow and outflow into the municipal market bond funds. I do not have that this week, but Betsy's going to speak a bit to that. But Betsy, what are we seeing here? Why are those short-term rates just scraping the very bottom of those bars?
Sure. So, I think a couple of things and really following on certainly some of the success we saw in 2020 within the municipal market, some pressure out on long yields back down towards historic lows, but the front end of the yield curve continues to have rates at or very close to record lows, I think for a couple of reasons. One, we continue to see Fed policy, which is likely to be supportive here in the near term, getting further confirmation last week from Chairman Powell. And I think too, and we'll talk about it as we move forward, taxable issuance continues to be such a strong component of issuance within the municipal market. We're seeing traditional tax exempt buyers participate within the taxable space. So that makeup of tax exempt and taxable issuance in particular on the front end has kept those rates pretty low getting started here.
One of the things I've shared with our viewers is just that we have a flat yield curve. Would you consider this pretty flat here?
Yeah, I think that's exactly right. A pretty flat yield curve. It's moved steeper certainly in recent weeks, but one that from historical standards remains pretty flat overall. I think keeping it flat is, as you mentioned, fund flows within the municipal space have been pretty robust. We saw last week 2.6 billion overall within our space, which is the third largest inflow on record. 1.1 billion of that specific to the high yield space, which is the largest 1 week recording in the high yield space going back to 2017. So, I think for all of those reasons, the yield curve and rates where they are remain pretty range bound.
It's pretty interesting is we've already had a credit spread compression, and now you're telling me 1.1 of 2.6 billion that flowed in is aimed at those higher yield product, which when we say a higher yield is not much.
That's right.
Lesser credit, but not that much higher yield right now.
That's right. So the reach for incremental yield where you have yields overall not even at 1.5% out in 30 years for the high grade spaces, I think some of the reason we're seeing such a move as we get started here in 2021.
On our next slide, we really focus on taxable issuances, both supply and where some of those yields have been. So Betsy, I'll turn this one over to you as well.
Sure. So certainly looking at that taxable visible supply and certainly the move towards a greater supply towards the end of 2020. And then the shift in spreads overall, I think certainly the taxable municipal market following corporate spreads and corporate issuance, if you will, is some of the movement there. I think as we've seen taxable spreads move tighter and really even edge tighter as we've started the year, it's just a function of tax exempt municipal rates are expensive relative to our taxable counterparts. So I think some of the outperformance within the taxable space is certainly attributed to that, and I think again, to some of the success within the municipal market overall is that split in taxable versus tax exempt issuance, allowing this space to perform pretty efficiently.
And I think over the last few years, we have a lot more taxable issuances than we would previously. And on our last slide, we're going to get into some potential changes in DC that may change that to some degree. On slide 4, what we detailed here is the US Treasury versus the 10-year AAA MMD. And I've talked to you a bit about how the US Treasury does not have state income tax for investors, where the munis have both federal and state income tax exemption. And what we have seen is that MMD yield has been higher, and in some cases much higher than the Treasury. But here we're starting to see that Treasury drift a bit over the MMD of a AAA MMD. So Betsy, can you talk a bit about this? Are investors saying they're less risk averse? Are they feeling more comfortable with municipal credits? What are we seeing here?
Sure. So I think a couple of things. We started the year with the idea that we'll see more spending out of Washington, D.C. That put pressure on Treasury yields, right? So that gray line moving higher. Municipal market outperforming, in that we didn't see much adjustment higher in yield in the first week. Last week, slight underperformance as Treasury yields came down, and municipal yields lagging or playing catch up just a bit. But I think a couple of things, right? Back towards new issue supply that remains pretty manageable overall, well below that 2020 average of about 9.2 billion per week. We haven't reached that in any 1 week here starting 2021. And that combined with strong seasonal reinvestment in how investors are putting money to work in the municipal market has our ratios, right, as we look at that difference at some of the most expensive they've been. I think a couple of things, right? What could put pressure on the reversing course or getting municipals back towards that historic average? The 10-year average, about 95%. Here we are today, municipal yields are about 72% of treasuries. So the upside or maybe downside level on yields is that puts 10-year municipal yields in around 1 or 105, where we're at a 0.79 currently. So there's not a tremendous amount of movement, if you will, if you look at kind of where that difference is. What could put pressure on it? Certainly supply. If we see that really pick up here in the next couple of weeks, we could see some pressure on municipal yields. And then what could put pressure on Treasury yields is certainly additional talk about stimulus spending and what that ultimate cost is going to be. So I think there's a couple of things kind of at play here. At the moment, municipals appearing expensive to our Treasury counterparts, but I don't see a lot of potential adjustment in terms of rates moving higher.
Well, as we work our way through the pandemic, there continues to be ideas in Washington, D.C. We also have a new administration that will be taking over the executive office tomorrow. We're recording this on January 19th, which is a Tuesday. And there's some items that are hot topics now. Could you get to what you've been hearing on some of these issues here?
Sure. Certainly new priorities in DC with President-elect Biden taking office tomorrow. We have a Democratic House and now a Democratic-controlled Senate. I think puts back to light some of, or puts back potentially some of the tools in the toolbox that have been so important to municipal issuers, and the idea that some of that perhaps gets pushed forward, whether that be in stimulus spending or a potential infrastructure bill, I think are all important as we make our way. Top of the list and potential priorities would be listed certainly on this page: restoring advanced refundings, which were taken off of the table in the 2017 tax bill. That would allow issuers to refinance outstanding debt with a call date more than 90 days in the future with tax exempt bonds. Certainly the way around it, and perhaps again, some of the reason we've seen an increase in taxable issuance is because that is the solution in the current market here. I also think expanded use of private activity bonds important as we look at some of those sectors moving forward. Bank qualified bonds, interestingly, smaller issuers are allowed to issue up to 10 million per calendar year and have those bonds qualify as bank qualified, where banks participate there, which ultimately is a tax benefit to those participating within that sector. And then lastly, and I think perhaps where most of the discussion could be in DC is creating a direct pay bond, similar to the Build America bonds back in 2009, 2010, as a way to allow for greater infrastructure needs as municipalities are challenged with potentially some of taking on additional debt within that space. I think we're going to see increasingly more focus on sustainable investing within the municipal space. Perhaps a direct pay bond helps bring that to light a little bit more here. But I do think there's a lot of optimism surrounding state and local governments within DC, and I think there's a good bit to make our way through as we start the year here in 2021.
Well, Betsy, there's the first and the last one are most interesting to me. That first one, though, feels like Lucy holding the football before Charlie Brown goes to kick it, and then she takes it out from under him every time. Because I feel like we've been talking about this every year. There's been a lot of conversation about this. So I'm very hopeful for 2021.
That's right.
But I'm a little nervous about kicking that football right now.
Yeah.
And then the last one, the Build America bonds and the direct pay. I think there's a few things when this came out with the last downturn. We looked for the conversations oftentimes for who's going to buy this taxable debt. But now with that significant taxable market that's already there, partially created by those advanced refundings having to be done taxable, maybe there's a bit larger base for that now. Mm-hmm. And then two, issuers, how do they get protection to make sure that if there's sequestration or something that goes on in the future, that some of their federal subsidy is not taken away from them?
Yeah, so I think you bring up two really interesting points that'll be important in making progress here. The cost of restoring advanced refundings, right? And what is that to Treasury really? I think was the reason we saw that go away back in 2017. Here we are with lots of stimulus on the table, upwards of $4.5 trillion, I want to say, in recent months. And so I think kind of the relative cost there is going to be important as that comes back to potentially making its way into our market again. And then I think more importantly, as it relates to a direct pay bond and sequestration, there has to be some sort of mechanism there where the state and local governments are not left challenged by what that potential subsidy is. So all things that are going to be important to the conversation as it is just getting underway.
Great, thank you. So what we have on our last slide is the Tillman Oldap & Associates Registered Municipal Advisors. I encourage you to reach out to any one of them. I want to first thank Betsy for her time. It takes a specific amount of time to prepare for this, and really want to thank her for her expertise. We always value that. But also want to thank all of you. Thank you for taking the time to watch again, and we look forward to talking with you in 2 weeks.